Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about MART interim report. MART International Group Limited offers a diverse range of businesses and services, including design, development, and sale of pop toys, blind box sales, retail store operations, including roboshops, online sales through various channels such as plus Tmall flagship store, plus Douyin, plus Pop Draw, plus other online platforms, wholesale channel services, internet technology services, customer development services, technology development services, playground operations, investment activities, exhibition activities. The MART stock price has skyrocketed by over 409.45% in the past year due to a combination of strong financial results, explosive popularity of its intellectual property, IP, aggressive global expansion, and favorable market sentiment. Key drivers of this surge include stellar financial performance, with revenue increasing by 106.9% year-over-year, and net profit by 203.9%. Explosive popularity of Labubu IP, which became a global sensation and significantly contributed to the company's growth. Aggressive international expansion, with overseas revenue exploding by 375.2%. In 2024, significant growth in plush toy category, with a 1,289% surge in 2024. These factors have led to increased investor confidence, institutional investment, and positive analyst sentiment, resulting in the stock's remarkable rise. The primary drivers of revenue growth for MART can be summarized into several key areas. Firstly, the company's diversified product categories and unique IP designs have contributed significantly to its revenue growth. The launch of new products, cross-sector collaborations, and content innovation have also played a crucial role in driving sales. Furthermore, the rapid growth of Twinkle Twinkle IP, expansion of licensed IPs through Pop Garage kits and co-branded products, and global licenses for most of their licensed IPs have all contributed to revenue growth. Additionally, the company's efforts to strengthen its brand and IP influence, leverage channel advantages, and prioritize product performance improvement in content-based e-commerce channels have also driven sales. In terms of geographic expansion, MART has seen significant growth in online sales in overseas operations, with a 967% increase in revenue from this source. The company has also expanded its physical store presence globally, with net increases in stores in China, Asia-Pacific, Americas, and Europe. On the other hand, there are no explicit mentions of primary drivers of revenue decline for MART. However, it is worth noting that overseas operations revenue decreased by 57.1% in some sections. Net income experienced significant growth, with a threefold increase of 385.6%, 234.4%, and 362.7%, as reported on pages 6, 26, and 29 respectively. This substantial rise in net income was accompanied by an improvement in profit margins. Gross profit margin increased from 64% to 70.3%, indicating a more efficient cost structure. The net profit margin also saw a notable increase, rising from 21.2% to 33.7% on page 6, and from 22.3% to 33.9% on page 29. These improvements in profit margins suggest that the company has successfully managed its costs and optimized its pricing strategy. The significant growth in net income and improvement in profit margins can be attributed to a combination of factors, including effective cost management, strategic pricing decisions, and potentially improved operational efficiency. The company's financial performance indicates a significant improvement in its ability to generate positive operating cash flow. The data shows that cash and cash equivalents have increased substantially, rising from RMB 6,109 million to RMB 11,922.7 million over the period. This increase is primarily attributed to the growth in cash generated from operating activities, demonstrating the company's efficiency in managing its finances and generating sufficient funds to support its operations. The company's debt level and interest expenses have undergone significant changes. The total financial liabilities have risen by 61% from RMB 2,352,357 to RMB 3,682,866, indicating a substantial increase in debt. Lease liabilities also saw an increase of RMB 34,352. Interest expenses on lease liabilities rose from RMB 19,766 to RMB 28,275, while overall interest expenses increased by RMB 85.9. These changes suggest that the company's financial obligations have grown substantially over time. Management is optimistic about the company's outlook and strategy. Key highlights include: the company will continue to seek strategic investment opportunities, focusing on IP-driven businesses with innovative products and services. It aims to expand its IPs by increasing types, base, and product categories while strengthening their essence and emotional connection with fans. To achieve this, management plans to allocate significant funds for expansion into consumer access channels and overseas markets through new retail stores and online platforms. Additionally, it will use a substantial amount of capital to fund potential investments in acquisitions and strategic alliances. Overall, the company is positioning itself for growth by investing in its IPs, expanding globally, and exploring strategic partnerships. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In 2024, it declared dividends of RMB 373,025 and paid out a total of RMB 1,083,288,000. Additionally, in the same year, it also bought back shares worth RMB 78,031. The company continued to pay dividends in 2025, with an amount of RMB 1,127,262 declared on page 61. Concerns about inventory buildup and supply chain disruption are warranted. The financial summary highlights two pressing concerns for the company: inventory buildup and supply chain disruption. The data suggests that there is indeed an issue with inventory buildup, as evidenced by a 154.6% increase in cost of inventories on page 79. This contradicts the lack of significant inventory buildup mentioned on page 33. Furthermore, the transportation and logistics expenses have skyrocketed, increasing by 546.7% due to higher freight costs and rapid revenue growth in various regions, page 27. Additionally, the impairment of inventory has increased by a substantial 262.9%. These statistics indicate that supply chain disruption is also a pressing concern for the company. Overall, these findings suggest that the company needs to address its inventory buildup and supply chain issues to mitigate potential risks and ensure smooth operations. That concludes the financial summary for POP MART. Feel free to comment below, and I will be happy to answer them when possible.